Ridham, the last time we spoke, you were talking about this budget being a magic one. Unfortunately for the equity markets, the reaction has been tragic, right? Because the markets didn't really take that in its stride. That said, one of the big reasons is because of the FPI outflows in the equity markets. And that's getting very, very aggressive and excessive, one could say, with their holding at multi-year lows. What's your sense? Earnings are going to return. We have capex spend that's going to pick up. And, the tailwinds in the lower crude price as well. Do you think they're coming back?
Let me try and explain this for the 500th time. There are only two cohorts in the market, domestic investors and foreign investors. You can break domestic down by institution, retail. You can do all those things, HNIs. Yeah. You can do lots of breakdowns of those. But we keep it simple, two cohorts. Even foreign portfolio flows can be broken down into many categories. Now, every morning, 9:15, this cohort on the right-hand side, which is domestic, is putting its bid in relentlessly.
Yeah.
How can this guy buy? Can't. Because you can't get a trade in the market if there are only buyers. Somebody has to sell. So I've tried to explain this, that the only time foreigners can buy is one of the two happens. Either domestic starts selling. They won't at these levels. You put share prices higher, they will. So foreigners will have to pay a lot more to get in, or the third player comes in, which is corporate issuers. Because net inflow into the market is what you get in terms of issuances minus buybacks. So that is your net inflow. So if corporate issuances take off, then foreigners can buy those issuances and they can participate. Otherwise, expecting that foreigners will buy without domestic selling ain't happening. It is just not it's not practically possible.
Right.
Which is what we actually saw for a lot of early, late 23, 24, because that was the block deal buzz, right? Nimesh would come every day, talk about the blocks and the QIPs.
A lot of issuances took place
issuances.
In 24, last quarter. If you look at the issuances on an annualized basis, it was about 2/3 of the previous peak. Yeah. And that was when foreign investors could buy.
Yes.
Yeah.
Once the issuances faded, their ability to outbid domestic is constrained.
Yeah.
You must understand that those who are 8,000 miles away from India understand India a lot less than those who are sitting 1 mile away from the stock market. So this was not the case 10 years ago. 10 years ago, the only buyer in India was foreigners and domestics were persistent sellers. Yeah. Retail took its holding in the market down from 27 to 8.
Yeah.
That's how intense, they were so scarred by the scam of the early 90s that a whole generation lost, exited the market. This is very different now.
Yeah. But Ridham, to come back, actually I'm coming back to the opening question with this. We completely take your point on the fact that how can FPIs buy if there's no seller in the Indian market? That point is well taken. But isn't it true that the last 5 months were also about realizing that India is not the only game in town? There was that US exceptionalism trade playing out, right? It was like the US economy and the US market could do no wrong. It was that tech trade playing out. Like you mentioned, there was China as well. China started grabbing attention as well. So from that standpoint, are we now better placed? Because US seems to have its own issues. China, we don't know. There's a lot of stimulus there, but we don't know. But from that standpoint, when you sort of hear global chatter, is it relatively looking better for India?
So the exhibit to look at, if you can put it up on the screen, is the relative valuations that India has versus the world. Foreign investors, the biggest problem they had was with respect to the price that they were paying, valuations. And India's valuations versus the world were like this. They've collapsed. Yeah. We're now a stone's throw from the bottom hit in COVID relative to the world. So we're very attractively valued.
Okay.
And at the same time, if you look at consensus earnings, and I am more bullish than consensus, I think growth is going to surprise to the upside because of the pivot in the policy. But let's take consensus. I have the consensus estimates for the world, rest of the world, and for India. That has actually made an inflection in the last 2 weeks.
Oh.
Yeah.
Relatively. Okay. Not because Indian earnings estimates have gone up, because world earning estimates are going down faster than India. So on a relative basis, India actually looks much sweeter than it has in many months now. Yeah. This is not just about the last 5 months. India was looking stretched for a long time into this. And foreign investors had cut back. Now, if you look at the foreign portfolio position in India, they are the most underweight they've been on Indian equities ever. I have data for 25 years. And the last time they were underweight was in 2007. And they've been overweight all along. And they've been cutting that overweight position for the last 10 years. They've been net sellers in the last 10 years because domestics have been buying. And now that underweight position has gone down to levels we have never seen. So, yeah, foreign portfolios exposure is low. Indian valuations on a relative basis looks better. Indian growth on a relative basis looks better. Policy is more certain.
Yeah.
And most importantly, India is now a low beta market, unlike the past. So
Yeah.
if you go back 10, 15 years, India used to be a market which had a beta of more than 1. And for your listeners, that means that India used to go up or down a lot more than the world. Now, if the world is in a trickier position than it has been for many years, the likelihood is that India will outperform. It's a India is like consumer staple stocks. It will outperform a bear market in the world. So it is quite attractive at the moment.
So 12 months down the line, if you put in a level for the Nifty, I mean, you're clearly sounding very, very optimistic with regard to the prospects, all the data that you put on board as well. The FI is underway. The retail, you're not worried about. I'm part of that, and I'm telling you that I'm keeping the money going in there. But, what kind of return should we be looking at on the headline index from here on, post that 15% correction?
So, Nigel, I was chatting with one of our larger mutual fund distributors, and he happened to meet a lot of institutional investors, and he said, you know, these guys are not going to make money in India. And I said, why do you say that? Oh, because their time frame is 1 month to 3 months. He said, my pool of investors, which is the retail guys, they come in, they put the money and go to sleep. So don't ask me for a 1-year view. The thing is that it is very hard to time the bottom. I know Surbhi opened the show by saying, I think it's a bottom. I have no idea whether it's a bottom or not. What I know is that stocks are looking attractive. And in time, this may prove to be a good time to engage. There's a lot of uncertainty around. It's a lot less than the uncertainty we experienced during COVID. But during COVID, one of the things I had read in my life, which was of great use to me, was that the point of maximum uncertainty is also equal to the point of maximum return. So we may not have maxed out on uncertainty. Maybe it gets a bit more uncertain in the next 4 weeks or 5 weeks. But as it gets more uncertain, the point of maximum return is coming in. Now, I'm not trying to avoid your question. The challenge of answering your question is that you have to put it in the context of the world. Yeah. So I have no idea what the SPX is going to do. I have no idea what China is going to do. I think India will beat these markets.
India will outperform from here.
And I think small and mid caps will do quite well into the next few months. Maybe they go down first a little bit more before they turn around, but it's very hard to catch them.
So India outperforms many emerging markets from here on, and the breadth of the market, the broader markets will outperform from here on.
I think India outperforms the world at large.
Okay.
Including the US markets from here. And I think, yes, mid and maybe from a sectoral perspective, you've not asked me, but financials are doing well right now. I think they'll lead this market out of its problems, and then it will transfer to consumer and industrials and other sectors.
What makes you optimistic on financials, and within that, how important will the private capex recovery be?
So if you take it from a long-term perspective, credit to GDP in the private sector is in the mid-70s, and India's per capita income is rising. And when that happens, people spend their future. That's what debt is. You're spending your future. It ends very badly, but that's beyond our lifetimes. In the meanwhile, people will spend their future.
2008 was within our lifetimes. Even I was covering the market back then.
We were only at 50% credit to GDP. And our banking sector did not have a problem. We faced a problem in 2008 because of oil prices, not because of a banking sector issue. We had a banking sector issue in the middle of the last decade because of NPLs. But even then, credit to GDP still remains low, adjusted for our per capita income, and there is no reason to believe why this will not go into 3 digits in the next 10 years. And you can do the math. If 75 goes to 100, nominal GDP growth is 10-11%, you get credit growth at around 15-17%. Good companies like Chola can do better. And more or less margins are stable. Even if they're slightly down, if you can manage your credit costs, you're delivering 15-17% earnings growth. Anybody at these multiples, there's a lot of money to be made in this.
All right, I guess with that, it's a wrap. We draw this conversation to a close. Thank you very much for being with us on this edition of Market Editor. More news and updates follow on the other side.